Nvidia has been on an absolute tear. Their sales have skyrocketed, going through the roof. This incredible growth has been fueled by the explosion of AI. Nvidia's chips are the brains behind this revolution. Investors have been pouring money into Nvidia, driving its stock price to dizzying heights. It's been a wild ride for Nvidia shareholders, but what goes up must come down, right? Well, some of the biggest names in finance seem to think so. They're starting to take some profits off the table. They are looking for the next big thing. These savvy investors are turning their attention to an unassuming but powerful investment, the iShares Russell 2000 ETF. This ETF tracks the performance of small-cap stocks, which are often overlooked by the broader market. Ken Griffin, the founder of Citadel, is a legend in the hedge fund world. He's known for his sharp instincts and even sharper trades. David Shaw, the brilliant mind behind D.E. Shaw & Company, is another Wall Street titan. He's famous for using complex algorithms to crush the market. These two financial heavyweights don't usually move together, so when they both make a big bet, it's time to pay attention. Recently, both Griffin and Shaw have been selling off some of their Nvidia holdings. They are taking profits. But they are not just sitting on cash. They are reinvesting that money in the iShares Russell 2000 ETF. This ETF gives them exposure to a basket of small-cap stocks. These stocks are poised for explosive growth. Why are these titans so bullish on small caps? The answer lies in the unique combination of factors that are creating a perfect storm for these often overlooked companies. The Russell 2000 is like the little engine that could. It's an index that tracks the performance of 2,000 small-cap companies. These companies are the backbone of the American economy. They are often overlooked by Wall Street, but don't let their size fool you. Small caps have the potential to deliver outsized returns. Right now, the stars are aligning for small caps. They are attractively valued. They are sensitive to interest rate movements, which are expected to decline in the near future. And there are several market catalysts that could propel them even higher. So, when Griffin and Shaw bet big on the Russell 2000, they are making a calculated gamble. They are betting that these small companies are about to get a whole lot bigger. Tom Lee is a Wall Street legend. He's known for his bold predictions and his uncanny ability to read the market. And right now, Lee is pounding the table on small caps. He's predicting that the Russell 2000 will hit 3,000 points, a significant jump from its current levels. Lee's optimism is based on a few key factors. First, he believes that small-cap valuations are incredibly attractive right now. In other words, these companies are cheap. Second, Lee points out that small caps are particularly sensitive to interest rate movements. With interest rates expected to decline in the near future, small caps are poised to benefit. Lee's prediction has sent shockwaves through Wall Street. Investors are taking notice. They're starting to realize that small caps offer a compelling opportunity for growth. Section 5. The Allure of Small Caps, Why Size Matters Now. Small cap stocks are like hidden gems. They are often overlooked by investors who are drawn to the bright lights of large cap companies. But savvy investors know that small caps have the potential to deliver outsized returns. And right now, there are several reasons why small caps are particularly attractive. First, small caps are often undervalued by the market. This means that their stock prices don't fully reflect their true worth. This creates an opportunity for investors to buy these companies at a discount and potentially reap significant rewards as their valuations catch up. Second, small caps tend to be more nimble and adaptable than their larger counterparts. They can quickly adjust to changing market conditions and capitalize on new opportunities. This agility gives them a competitive edge, especially in today's rapidly evolving business landscape. Section 6. Value Unleashed, Small Caps Poised for Growth. Small cap companies are like coiled springs, ready to unleash their pent-up potential. They are often overlooked by investors who are drawn to the safety and familiarity of larger, more established companies. But savvy investors know that small caps offer the potential for explosive growth. One of the key reasons why small caps are so attractive right now is their valuation. Simply put, they are cheap. Compared to large cap stocks, small caps are trading at a significant discount. This means that investors can buy a piece of these companies at a bargain price and potentially reap significant rewards as their valuations catch up. Another factor that makes small caps so compelling is their growth potential. Small companies have more room to grow than large companies. They are not as constrained by their size or their existing market share. This means that they can achieve higher growth rates, which can translate into significant returns for investors. Section 7. Interest rate dynamics, a tailwind for small caps. Interest rates are like the tide, they can either lift all boats or leave them stranded. And right now the tide is turning in favor of small cap stocks. Interest rates are expected to decline in the near future, and this is a major tailwind for small caps. Why are interest rates so important for small caps? Well, small companies are more sensitive to changes in interest rates than large companies. This is because they typically have more debt. When interest rates decline, their borrowing costs go down, which boosts their profits. With interest rates expected to decline, small caps are poised to benefit. Their borrowing costs will go down, their profits will go up, and their stock prices are likely to follow suit. This is why savvy investors are paying close attention to small caps right now. Section 8. Market catalysts, igniting the small cap engine. The stock market is like a car engine, and right now there are several catalysts that are about to fire up the small cap engine. These catalysts are creating an environment where small cap stocks are poised to outperform. One major catalyst is the strength of the U.S. economy. The U.S. economy is currently firing on all cylinders. Unemployment is low, consumer spending is strong, and businesses are optimistic. This positive economic backdrop is particularly beneficial for small caps, which are more closely tied to the domestic economy than large caps. Another catalyst is the potential for tax cuts. The current administration is considering a number of tax cuts that would benefit businesses, including small businesses. These tax cuts would boost corporate profits and could lead to increased investment and hiring, which would further fuel economic growth. Section 9. Expert opinions. Wall Street weighs in. Wall Street is buzzing about the potential of small-cap stocks. Market experts are lining up to share their bullish views, citing a confluence of factors that make small caps an attractive investment opportunity right now. JP Morgan's renowned strategist, Michael Sembalest, believes that small caps are poised to outperform in the coming years. He points to their attractive valuations, their sensitivity to declining interest rates, and the strength of the U.S. economy as key drivers of growth. Sonu Varghese, the astute chief investment officer at Carson Group, echoes Sembalest's optimism. Varghese highlights the compelling investment case for small caps, emphasizing their potential for outsized returns in a market where large-cap valuations have become increasingly stretched. Section 10. A balanced approach, navigating the market maze. Investing can feel like navigating a complex maze, especially in today's volatile market. But don't worry, there's a way to approach it that can help you reach your financial goals while managing risk effectively. One strategy to consider is to start with a solid foundation by investing in a broad market index fund, such as the SPDR S&P 500 ETF, also known as SPY. This ETF tracks the performance of the S&P 500 index, which is composed of 500 of the largest U.S. companies. It's a great way to get exposure to the overall stock market without taking on too much risk. Once you have a solid foundation in place, you can consider adding a small position in the iShares Russell 2000 ETF, or IWM. This ETF tracks the performance of the Russell 2000 index, which is composed of 2,000 small-cap stocks. Adding some exposure to small caps can potentially boost your returns while maintaining a well-diversified portfolio. Section 11. Conclusion. Embracing opportunity, managing risk. Remember, investing is a marathon, not a sprint. It's about finding opportunities for growth while managing risk effectively. The potential of small-cap stocks is undeniable, especially in today's market environment, but it's crucial to approach investing with a balanced and informed perspective. By starting with a solid foundation and gradually adding exposure to small caps, you can position yourself to capitalize on their growth potential while maintaining a diversified portfolio. Remember to do your research, consult with a financial advisor, and invest for the long term. The rewards of patience and discipline in investing can be